afternoon, everybody. My name is David Ashiabo, and I'm the coordinator of Making Finance Work for Africa. And we're very pleased to be hosting this webinar on finance in Africa, overcoming the challenges, in collaboration with our colleagues from the African Development Bank. Before we started, I'd like to go over a few housekeeping items and instructions on how to make sure that we all get the best out of today's webinar. So the web is scheduled to last 60 minutes, and we will try to keep to an hour. If we do overboard, we will not go overboard by more than 15 minutes, and that's a commitment, so you can hold me to that. For comfort and to ensure the best audience for all participants, we will be taking all participants centrally, and that's just because when we find that when people are not muted, there's a lot of feedback on the line, so only the speakers will be muted, and that will be done centrally. We do webinars to be as participative as possible, so we would encourage you to submit questions as we go along. This is via the chat or the Q&A tabs on your screens, which are to the right of your screens, and we will be if you want to submit a question, you go to the chat button and submit it to the MFW4A Secretariat. We have an army of people manning the chat rooms who will be screening the questions, and we will try to pick up as many of them as we can. If we cannot get to your questions after, we do try to, with the help of our speakers and other resources, try and submit written answers after the webinar. So please do not if we do not pick up your question. No point is that the slide deck and a recording of this webinar will be available and emailed to you within 4 hours after the end of the session. So I guess that would mean close of business on Friday. And also, please remember to fill out the survey that will appear automatically after the session. We are very keen to hear from you because we do quite a lot of these webinars, and your survey responses will inform the structure of and content of future webinars. We would also encourage you to share any ideas, including for subjects that you may wish to see covered in future webinars. Before Sorry, I get to content. Sorry, we have a bit of a technical issue here, which I think is now resolved. Before we get to today's webinar, and that's the the content of today's webinar. We're still having a bit of a technical issues with my with the sound setup here. I think we've finally resolved it now. Go. So I'm David Ashiabo, as I said. I'm the partnership coordinator for Making Finance Work for Africa. I will be saying a few words making finance in a minute. Our main speakers today are Mr. Lamine Dramé, who is the Chief Trade Finance Officer with the African Development Bank, And then we have Mr. Jan de Clerc, who is manager of Cornerstone Advice Plus, and I will be introducing both speakers just before they speak. So, the objectives of this session are three. We have three main objectives for this session. First of all, present and discuss key findings and lessons from AfDB's survey on trade in Africa, which was released in September 2017. Lamine is obviously the expert on that, and it talks about overcoming the challenges in trade finance in Africa. We will also have a discussion about how to enhance banks' ability to supply trade finance Africa, and particularly for SMEs. And then our panelists will be giving us some recommendations toward the session. So, what got your attention? Just a quick words on making finance work for Africa. So, make work for Africa, we bring together development partners, the African financial sector, public and private, so all representatives from ministries, policymakers, central banks, regulators, right to commercial banks, non-bank financial institutions, industry associations, etc. Support the development of the financial sector in Africa. We do this through knowledge sharing and promoting cooperation on financial sector development. So, as you can see on the slide, our members share a common vision of sustainable African financial systems, provide universal access by 2030, and offering a full range of products and services for the continent. Funded by the African Development Bank, which also hosts us, the Agence Française de Développement, the government of Germany through the Federal Ministry for Economic Cooperation and Development, GIZ, the Ministry of Foreign Affairs, the Netherlands, MINBUSA, and also the European Investment Bank. We have some main strategic priorities: financial inclusion, under which we have programs in digital finance, agricultural finance, and essence, financial stability and governance, which really started out focused on border banking supervision, but is becoming a cutting issue, as you will see as we go through this webinar. And also, we have a long-term finance work stream. So this webinar is really the launch of a new work stream, trade finance. We call the Making Finance Work for Africa Trade Finance Initiative, undertaken with funding from the government, so through BMZGIZ and the Development Bank. Our initiative is hosted by Making Finance for Africa, and the idea is to improve the trade finance market in Africa, promote regulatory compliance, and implementation of cost-effective approaches. The ultimate goal of this trade finance work is to obviously increase the availability of trade finance through better designed products, through through appropriate regulation, I think, are the words that I should use, and also through building capacity for some of the the local banks in Africa. I've introduced our keynote speaker for today, my good friend and colleague, Lamine Dramé. Lamine is a Chief Trade Finance Officer at the African Development Bank. 2 decades of experience in finance, working in countries as Gambia, Senegal, Tunisia, and Cote d'Ivoire, and in industries or areas of finance as diverse as government, NGOs, commercial and development banking sectors. He is in trade finance, but has also worked in treasury, accounting, corporate banking, finance, and portfolio management. And Lami is really I can say so, the driving force between FDB's trade finance survey, which he is now going to present. So I'll just hand you over to Lemming now. Thank you.
Thank you for that introduction. Good afternoon or good morning, depending on where we are in the world right now. So today we just want to focus on a few themes here. One is trade finance in Africa, especially for SMEs. The other is talk about inter-Africa trade and what the issues are in that space. And then thirdly, we'll just focus on SMEs themselves as a segment. Let's just pause for a moment and think about this. Africa is about 11% of the world population, accounts for less than 3% of global trade. On the other hand, it accounts for nothing less than 80% of private sector employment in Africa. But we realize that they represent no 30% of the trade finance portfolio of banks on the continent. Those are things we need to bear in mind as we go through this presentation. But this afternoon, on our side, we just want to focus on a few things, and I want to give you the outline of what we will do quite quickly. One, in the first place. I mean, what was the approach we used? What are the main findings? What are the lessons learned from the survey itself? What can we do differently the next time we do this or somebody else wants to do it? Then we will talk about our own trade finance program as AfDB, the successes we've registered, and then move on some of the recommendations that, policy recommendations that we can all work together on to access to finance for SMEs and corporates in Africa, and round this up with some conclusion. So we started our program in 2013, and one of the first questions we are being asked is, what are you trying to serve? Who are you trying to serve? What is the gap? People are around figures like $25 billion annually in Africa. And they say, but what is the source of that? It was difficult to really establish exactly the gap in Africa. So we said to ourselves, to get into this space, you need to have the facts. You need to know really what the constraints are. And that is, a more robust sort of kind of study and a body of knowledge. So we said we need to contribute to this as Africa's premier development finance institution. We need to do more in this space. We need to contribute to the body of knowledge. Well, we also had to convince our own internal stakeholders, management and the board. Indeed, this is good value for money for AfDB. I know trade finance is invisible. You don't see it. What the finance institution world knows is really infrastructure. That is something you can see. The question was, are we taking away scarce resources from structure projects into trade finance? So we had to demonstrate to them the importance of really getting involved in trade finance, and they actually contributed to that. But trade and trade finance is the alpha and omega of development. How you build infrastructure without trade? The cement, the heavy equipment, all to be imported or manufactured, and that takes trade. Once you build the infrastructure, what do you do with it? With trade. So the power that is generated in the world is used by industry. It's not used by you and I. It's used by offices. It's the road used by trailers. The ports are all used for trade. So trade facilitates development, but development happens to facilitate trade. And through a survey and the results of it, and this sort of explanation, I think everybody came around to really indeed this is an area we need to be. In much as we cannot see it, but we should be able to explain exactly how it contributes to the development in Liberia. So basically said, okay, fine. Should we do this on a sample basis? Just, a few countries, a few banks, and so. But no, we said, we should be visionary here. We should really think big. Let's cover the entire. So we did a primary survey covering 100 banks, local banks and subsidiaries of foreign banks in Africa. The survey was sent to banks in 49 countries, almost the entire continent. There are a few places we couldn't cover. And we had a response of 27%, which by is excellent. In this type of surveys, even 15% is seen as a success. But 246 banks sent in good quality data. Two reasons for that. One, they're present in about 30 different countries. We were able to use our country teams, the economists, and so on, to really constantly remind the respondents to basically fill the questionnaire. Secondly, was that because there are quite a number of banking groups, we were able to go to the headquarters of these banking groups and then ask them to speak with the subsidiaries to contribute to the survey, because their response was really going to be very vital. So those factors really, enabled us to get this sort of response rate. Now, that everybody is talking about is the gap itself, and estimated it to be currently between $90 and $100 billion annually. And Africa's total bank trade finance is estimated at about $400 billion. It's a third of Africa's total trade. In those days, about $1.2 trillion. Nowadays, because of the fall in commodity prices, actually Africa's total trade is less than $1 trillion and about 2.6% of global trade. Then, in trade, you found out it's about 20% for financing. This is why banks, out of the total that they provide, 20% goes to intra-Africa trade. There was also a finding, which is not surprising, that indeed finance is a low-risk asset class. The NPL across the continent was 5% compared to 12% for all the asset classes. But this is still quite high compared to less than 1% for the world. So, a long way to go in that area. But for us, the survey revealed that they account for about 28%, less than 30% of the portfolio, the finance, the portfolio banks in Africa. That is, I said at the beginning, SMEs account for no less than 80% of all private sector employment in the continent. So, in that they are the engine of growth, something has to be done to really have greater access to finance. But there were disparities, regional disparities between East, South, Central, whether the banks are state-owned, whether they are privately owned, whether they are local or foreign, or basically if you look at the size, whether they are oil importing countries or oil exporting countries. Now, we'll discuss trade, the constraints in general. We'll talk about SMEs and intra-Africa trade. But we asked the respondents a question. Who are your 5 confirming banks on the continent? So it's not really the market size of the key core banks, but it's the frequency within which they appear in the top 5% of the respondents. And was cited most often. 10% in terms of relative frequency was Commerzbank. But here is there is no African bank in the top 7. Bank of South Africa appears in the top 10. Some history to this, that historically international banks have dominated the confirming bank space. But it was Africa's direction of trade. Because Africa trades more with the world than with itself, the confirming business is skewed towards international banks who have presence outside of Africa. This constraint, as you know, in Europe and in America, open account trading without the information is what is equivalent. But the ponderance of letter of credit confirmation in Africa and in Asia. If you would want now and discuss a bit about, furthermore, we ask the banks for you, what shares to the growth of your portfolio? It sounds really surprising that indeed competing, because there is a lot of competition, they find it difficult to grow their business. Risk capital, which is a constraint. Correspondent banks, the availability of lines from these banks. Also stock, which came out as number 7%. So that the ability to really move up the scale, move away from plain vanilla trade finance products to more sophisticated ones, it's a constraint for them. But then we phone and then ask them about really constraints they have and why they reject the trade finance requests of their clients. So there are two portions. The first portion chart comes from our own survey, and that 66%, of the really relate to client creditworthiness and insufficient collateral. And that reasons why banks reject the trade finance requests from their clients. But at about the ICC did the global survey of finance, and it asked all banks globally, what significant impediments to trade finance for you? 90% said that MFW4A are really very significant factors. They are unable to do more. I mean, if you look at one is regulatory requirements, low credit rating, and the low issue bank credit rating. So factors that really affect more the developing world, affect more Africa. And as many of you know, and as my colleague is going to talk about somewhat of the risking correspondent banks are leaving the continent, you will see these things come out more clearly. That there's a lot more work to do in this space. The SMEs particularly, like I said, the top clients account for 58% of their portfolio. It's only 28%. First-time clients, 15% or 15%, as the case may be. But it really points to the skewness and how there's a lot of preference for large corporates because they have low, they tend to be more relationship based in terms of the approach to business compared to really SMEs. And that's a challenge that SMEs don't have enough access to trade finance. That's part of the story. I mean, are they really risky? Because that's really the question we need to answer. If they are, then perhaps banks have a reason why they tend to shy away somewhat from the SMEs, and which means to address those issues. So SMEs, across the continent are supported by the banks. Like I said, for the asset NPL, all trade finance is 5% compared to 1% or less than 1% for the world. And for first trade finance clients, it was 3%. But SMEs, 14%. And this is only trade finance. This is it's quite significant. There are variations across the continent. It is about 11% in east and south. It's as high as 31% in Central Africa region. This is quite high, and So basically, I think that is something we need to consider. Yes, SMEs don't have as much access funds as they should have. Indeed, also, the risk is somewhat elevated there. Then the other was really intra-Africa trade, given the importance of intra-regional trade itself. Because as you can see, I mean, there is some correlation between the level of intra-regional trade, the trade that happens within a particular area or continent, and the level of development in that continent. Latin America, Africa, and the Commonwealth of Independent States tend to have lower intra-regional trade. But if you look at Europe, 68% of the trade that Europe does in Europe itself. 50% of what North America does is within America itself. And Asia is 52%. Those are really the more developed parts of the world. Yet in Africa, it's 18%, which is quite low. So to move forward, to do more, to have greater levels of development, it's important that somehow intra-regional trade is expanded. We looked at the composition of the inter-finance of banks. That you know, Southern Africa and East Africa, where the banks provide more of their facilities to trade finance compared to other parts of the continent. You look at East Africa, 20% of the portfolio of the trade of the banks is for intra-Africa trade. In North Africa, is low as well as Central Africa, and also the level of integration in regions. As we know, Eastern Africa and Southern Africa are more integrated than the other parts of the continent. In countries, it's only 10% of their trade is really for trade finance, intra-Africa trade. That also is explained by the fact that oil is a big chunk of their trade is really exported outside of the continent. I think we basically discussed a few points. We talked about the constraints generally. We spoke about SMEs and also intra-Africa trade. And we also realized that, this is something that perhaps we need to spend a bit more time on, to study more, or other parties may be interested in it. And in so doing, a few areas that I think we all need to perhaps focus on to improve. One is, do you make sure that the response rate to this sort of, we've got 27%. I think the results would be even much more credible if we were to have 80% response rate or even 50%. But that's an area we need to focus on. But we also need to manage fatigue. You don't have to do this too often. Your response rate we are inundated with because from AfDB or from others on similar things. So that's something that we all need to manage. But also to ensure that the response is not only satisfactory, but it represents all the regions quite considerably. So the response rate from North Africa was much less than we had in Western Africa or from East Africa. Again, the issue of the thing of the survey. I mean, next time to do these things will be like January, when banks are reporting their numbers, and so you give them 2-3 months. But then you really want to get the response coming through and to collect your data, then all their annual accounts would have come out. If you do this in in September, by the time you publish your data, it's already outdated because it will go into the next year. I think so. We have here, as you say, what we are discussing really the 2014 numbers. So we should be able to be more timely in publishing in these results. So then they have a greater impact in terms of policy formulation and implementation. Now, to quite say a few things about our own trade finance program. Is having hard things that we have, how SMEs are challenged, what intra-Africa trade, and how we need to build that up. So we got into this into space formally in 2013. Offering product lines, guarantees liquidity, risk capital, and soft commodity agriculture. And then all of these are really other parts of the bank that do the trade enabling policies, the infrastructure projects that we do. Like I said before, and trade is really at the beginning and the end of infrastructure projects. So infrastructure has become quite important. In addition to the city building, that we know, as I said, 7%. When 7% of responsible for the constraints really had to do with staff capacity. So we have done about 6.5 billion of trade with all types of institutions, regional financial institutions to local commercial banks, to international confirming banks, and so on. And over 1,650 transactions, and for us, 58% account of SMEs, compared to 8% for banks. For intra-Africa, 20% of all what we did was really for intra-Africa. We could do more, but I think we are cognizant of the direct trade in Africa in general, and that's not going to be easy to change. So having given you this sort of synopsis of the survey itself and what we have done, I think all of us together can really work hand in hand to do more, to unlock the continent's huge potential to accelerate development and increase access to finance for SMEs. So with the alternative trade financing vehicles need to be given more funds, trade funds, bringing in companies, looking at other instruments, supply chain finance and civil financing, to complement the traditional sources of funding, these loans and LC confirmation is something we need to do. A second one, and which perhaps is the most important, is we restore corresponding banking lines back to the continent. A lot of the risking is taking place now, probably arising from regulation and AMLKYC. Again, also the risk perception of Africa itself. So all of us need to work much harder to improve that perception. Sometimes it's different from the reality, but people, credit officers sitting outside of the continent work more with the perception than the reality. So something that we all need to work on. Capacity of local banks, we need to help them a lot to learn documentary credit, to understand trade finance a lot more, to facilitate the communication between them and their larger correspondent banking partners. And then you learn the ecosystem itself. There's a lot more that can be done. I mean, you had a chat with some colleagues and talk about fintechs and blockchain and how those could become very useful in providing alternative source of finance. We need to see how we embrace fintechs, how they can work together with the banks, that the technology is there and that the liquidity is also provided to get to go back to the chain to facilitate more access for SMEs. The ends themselves, we're doing quite a lot, but I think there's room for greater collaboration to avoid overlaps and so we have greater impact. At the same time, our role, as you know, is to create greater awareness, to facilitate collaboration with regulators internationally and locally, so that the environment within which banks operate finance is more conducive. The hard and soft infrastructure issues are not really trade finance, but in border issues, the customs controls and the shipments, all the infrastructure, logistics around trade in Africa requires great room for improvement. But at the end, all ways, we've heard a lot from the supply side, from the banks. But I think the studies and so on need to talk about the SMEs, the demand side. What really are their constraints? What do they expect from the banks? And do they think we can all work together to alleviate the constraints there are in the market right now? I think and would really just be to cap this, to give you a recap of some of the things that we've discussed, that this is still quite significant and 100 billion. SMEs and Africa trade are really underserved. Policy, needs to be formed towards reducing those constraints. That regulation KYC requirements have become really the number one issue in terms of access and for the banks. Local banks don't have access to the liquidity, especially. It's more challenging for them to provide the support that SMEs are looking for. And as I said, I think studies need to be more targeted. We need to be more collaborative. We need to see how we can involve others in these studies that we do, rather than going all alone. Can we, bring in others? Can we bring in the ICC, for example, who do a survey? Can we partner rather than doing one for Africa, one for the globe, one for Asia? Could we incorporate all of this into one study that we can all and where we can basically, really try and get greater participation coming through? That we need to explore the alternative trade financing sources a lot more. We feel like just relying on liquidity from bank mission, it's not going to really do it. It's just a third of what they do is for SMEs. A lot more could be done, and that really calls for being more active, looking at these alternative sources of financing. I think, David, I would pause here for now, and then we'll come back later if need be.
Thank you very much, Lamin, for that very succinct and interesting. And I think you managed to pack a lot into your 15 minutes. We already have some questions for you, and I myself have noted down some questions. But what I'm going to do now is to introduce our second speaker, Jan de Cler. Jan manages Cornerstone Advisor, a consulting firm, specialized clients advisory, audit, in operational risk management. He worked for 16 years in West Africa with the Citigroup, where as Chief Compliance Officer, he managed the day-to-day compliance/AML advisory function, in addition to leading regional compliance projects covering multiple subsidiaries and branches of the institution, so Citigroup within Africa. And Dan is going to talk to us about his whole issue of de-risking and how that is affecting correspondent banking relationships in Africa and what some of the causes behind that might be. So I will hand you over to Jan, and then we will come back and do Q&A. So please, we've got some questions for Lamin already, but please, if you have any further questions, please keep sending them in. Thank you. So I'll hand over to you now.
Thank you. Can you hear me, David? Hello?
Yes, Jan, we can hear you very clearly.
I'm unmuted.
I had muted myself. So
okay,
yes,
okay.
We can hear you very clearly,
that's
so
good.
Please go ahead.
I wanted to make sure I was unmuted.
Yeah.
David. Thank you very much, David, and thank you, Lamin, for this brilliant presentation on trade finance in Africa. Participants, also, it's a pleasure for me to actually discuss this presentation with you. We can see that one of the challenges described in the presentation presented by Lamin is bank intermediated trade finance gap. This has actually registered a positive trend, but it's still significant for the continent taken as a whole. As stated in the AfDB report, this gap was still at around $100 billion in 2014, more specific $91 billion in 2014. And Lamin's presentation, we can see a number of constraints explaining this gap, among which the limits with correspondent banks. Lamin's presentation shows that this constraint comes in third position as competition and risk capital in the AfDB survey, with an average rate of 18%. He also stressed out the fact that the ICC study shows a weight of 90%, 90%, on IC AML issues, and actually rightly point out in his conclusion that AMLKYC issues related to correspondent banks are the number one reason of the constraints in that area. So my session will focus on these specific constraints, the limit with the correspondent banks, or otherwise called de-risking of correspondent banks. And I will come back to some basics and definitions in order for us to move forward in this discussion. De-risking in this context refers to partial or complete withdrawal of international correspondent banks from a market or financial institution. But de-risking can also refer to maintaining relationships with a financial institution with restrictions applied to that relationship, including restriction on foreign currency limits and types of transaction limits. The phenomenon of de-risking has clearly an impact on trade finance in Africa. However, from what I know, this impact on Africa trade finance and Africa trade in general has been specifically measured and quantified. We know that this issue of correspondent bank de-risking is a rising concern for the trade finance in Africa. The very limited amount of resources, studies, or reports that actually quantify the shortfalls directly attributable to correspondent bank de-risking issues in Africa. Even at this stage, we cannot dimension exactly the extent of the impact of the de-risking issue on Africa trade. There are a number of studies highlighting the causes. This leads us to discuss the two main factors driving the risking currently. Those factors are the insufficient volume of transactions that African banks bring to those international correspondent banks. Sometimes they judge that the volume is insufficient on the risk. And also the perceived high risk related to compliance of African financial institutions, as Lamin also mentioned in his presentation. Lamin also mentioned, I insist also on the compliance risk side, on the perceived risk, because sometimes the African local banks, as perceived by international correspondent banks, is not necessarily commensurate with the actual risk of that specific financial institution being the risk. And this perception is partially explained by the fact that assessment done by the international correspondent banks on any African financial institution is largely influenced by the overall perception of the country compliance risk. This perception of the country risk is driven by a country-level assessment of policies and infrastructures around anti-money laundering, risk financing, KYC, as well as the supervisory regimes of the banking sector. So the point I just highlighted actually reinforces the AfDB report presented, especially around policy implication aspects. It also stresses on the ability for African governments to enhance their policies and infrastructure around anti-money laundering, compliance, and supervisory regimes of the banking sector in their respective countries. So, governments will boost the confidence of the national finance community in their local banks, a positive impact on trade and trade finance in their respective countries. I will actually conclude my discussion right now until we continue with the participants by saying that any effort made on ground, anti-money laundering, KYC compliance by individual financial institutions of an African country, we hindered by weak compliance policies and infrastructure at country level. Of course, weigh the requirements and efforts needed to be done at the institutional level. Those efforts, institutional bank level, should go hand in hand with country level policy and infrastructure enhancement in the anti-money laundering and KYC arenas. A strong supervisory regime of the financial sector at country level ensure this coordination and the coherent enhancement at country and institutional levels at the same time. I'll leave you with this now and hand it over to David, and we can continue this discussion with you, David, and all other participants. Thank you much.
Thank you much, Jan, for that. We're now going to go into the Q&A. We've been having a number of questions coming in through us. And Jan, I think I'm going to address the first one to you, even related to Lamin's presentation. The question, I didn't write down who it was from, but it says, you know, on this you had Lamin where it had the 90% anti-money laundering KYC. Hold on. No, I want to go back. Yeah. Yeah, on this slide, the question from Leila Latif, I think the name, sorry, Leila. It says the AMLKYC factor, 90%, in that this is the main reason why internal banks refuse to confirm transactions from African banks. So I'm going to let Jan sort of a few words about that, and then maybe Lamin, you can come back with the technical discussion, and then we'll take some more questions. So Jan, if you can just react to that, please.
You, David. Actually, for being on the other side in Citibank and participating in the assessment of the AMLKYC framework of recent African banks with Citibank London and Citibank New York, I can surely say that the LKYC were among the priority top reasons for international banks not granting lines and not confirming transactions of African banks. We also have the volume, because sometimes, but all that is tied to the risk, because correspondent banks see what they will gain from a relationship with an African financial institution in terms of volumes and revenue. They will tie it to the risk associated with that financial institution in Africa. And risk is mainly measured now on the AML and KYC framework criteria. So yes, I would say that the AML-KYC, from what I know and from my own experience being on the other side and working with Citi London, Citi New York, are actually the main reasons why international correspondent banks are being more prudent to participating in trade transactions with African banks. Yes.
Much for that, Jan. So now I'm going to ask you, Lamin, to do a few words on that issue.
David, I think Jan has really answered the question, because AMLKYC is really the most significant factor right now. Really is regulatory requirements, and that's because when you look at it, the regulation as it is right now on Basel, for example, is getting stiffer and stiffer. I mean, capital requirements have become quite important, and when you look at the profitability of some of the relationships in Africa, you wonder whether it is worth the while investing that capital, for the assets that you get in Africa. This way. I mean, assume $1 million from a bank in Africa, but for reason you have an AMLKYC issue, end up having to pay $1 billion in fines. Forget the initial cost, but based on damage that's fine or exposure does to you is quite significant. And internal wary of this, and they don't really want to take the risk. So African institutions, African governments need to do a lot more to thin, our KYC and AML, aspect of our business to improve the perception out there at Africa, but to demonstrate that indeed they're capable of handling AML and KYC reasons. So I think the question is apt, but the answer provided Jan and what I've just added to is really accurate, that AMLKYC considerations are one of the biggest drivers of the risking that we're seeing on the continent right now.
Lemine, the next question is from Marcus Schultz about the creditworthiness of local banks. So what it says is, how strongly worthiness of banks affecting access to trade finance facilities with international banks? So it's kind of related to the first question. So how much of it is AMLKYC, how much is creditworthiness of local banks themselves? So that's the first part of his question. And the second part of his question is, and how could he address this? So I think I'm going to come to you first, and then we'll go to Jan and see if he has anything to add.
So the creditworthiness of local banks is closely related to the country risk itself, and the rating of most African countries is really low. You find it difficult for the local banks to pierce that rating. So those are related. But we know that trade really gets paid, and the international banks know that local banks pay their trade obligations, if for nothing, because the number of confirming banks out there are limited. If a local fails to honor its trade finance obligations, they are out of the correspondent banking business almost altogether. So what it is not so much about the banks themselves and their ability to settle their trade obligations that they do. In many cases, it's related to the country's rating, which is low. Really.
And did you have anything to add or anything?
Yes, yes, David. I can add to that on the AMLKYC side. A portion of the question: what can we do? Creditworthiness and AMLKYC. AMLKYC side, I can give the example of the West Africa Economic and Monetary Union, the WAEMU zone, that has actually started the policy enhancement aspect on the compliance side, and driven by the BCAO, Central Bank of West African States, issuance of a common directive on anti-money laundering regime of the WAEMU countries. Actually, I can cite this as a very good example of policy enhancement and standardization across an economic region, and could be rated also in other economic unions of the continent. The infrastructure enhancement, though, from what I know, to my knowledge, has not yet occurred, even in the WAEMU zone. And my suggestion here is that this, what can be done is the policy and infrastructure enhancement could be actually achieved by actually strengthening the policies, as I mentioned, with the example of WAEMU, but also on the infrastructure side through synergies or mutualizations or coming together to the creation of shared facilities of excellence around AML compliance and KYC, actually consistently implementing the policies across the board at country or regional level or economic union level, depending on context in which you are. So that was about what I wanted to add, David. Thank you.
Ian, now have a series of 3 questions which are directly for Lamine. So I don't know whether to read them all at once or whether you want to sort of take them at a time. Okay, so wants to take them in a 3, please. A very brave man. So the first question, and this is from Amuni Dylan. First question is, Liberian banks serve confirming banks finance transactions? Yes or no, and please explain. The second question, why is AfDB not a trade finance lines to African banks, especially Liberian banks, as the IFC? So that's the question. Question is, and the third question is, what is AfDB play to make African banks independent of American or European banks in relation to borrowing? So let me.
David, and thank you, Dylan, for those questions. As to whether Liberian banks can serve as confirming banks, yes, they can. And especially the export being originated out of Liberia. The exporter is in Liberia and prefer the Liberian bank to serve as the confirming bank. But the African state is in such a way that right now, the kind of banks that can serve confirming banks are really international banks. But there's nothing stopping a Liberian bank from being a confirming bank. It really, by and large, depends on the exporter who would specify the sort of bank that can serve as a confirming bank. Are we facilities to banks in Africa? Yes, we're doing quite a lot on the continent itself. As you can see on the slide that we have on right now, provide facilities to EcoBank, to CBA, in to AfriExim, ATA, First Rand Bank, all of those. They're all African institutions. So we're doing quite a lot. In Liberia itself, it may be too early to speak for confidentiality, but we are considering providing facilities to at least 3 banks in Liberia. So at the end of June, hopefully, you will see in the papers that to engage banks in Liberia. In the past, we have done some in Ghana. We've done a lot in Nigeria, in Mauritania, in Cote d'Ivoire, and so forth. The continent is large. So realize that LICs, and especially the transition countries like Liberia, need support right now because the de-risking affected countries like Liberia, the Gambians, and the small countries. So a desire to help the countries, not only with liquidity, but also with risk mitigation facilities in terms of giving them opportunity for letters of credit to be confirmed by international banks. So guaranteeing their risk in some way. Now, on the third question as to what AfDB can do to delink or to make banks more independent from the European or American banks, in this of globalization, as we are talking about even more trade, and we pointed out trade is significantly positively correlated with development. We need to get more into international trade. We need to partner more with the rest of the world. And as you know, 80% of international trade is settled in dollars. It's difficult to do otherwise than to engage to engage banks in America or in Europe. If you think it's really to see how we can enhance that collaboration, how we can enable international banks, European, American, or Asian, to engage more and more with African banks, to provide them with the necessary liquidity, to help them with capacity building and so forth, so that we're more integrated into the financial world. I think that will be the way to go down to further delinking ourselves from the rest of the world.
Thank you very much for that, Lamine. And if I can add a couple of, I think a lot of the answers to that question sort of, for me, go back to the issue. There was a slide that you had about African trade and the link to regional integration. So, it's the issue of the issue of it was that one. Yeah, it was that one. So the issue of whether a Liberian bank can confirm an LC or not, well, would be to that, because it would probably be acceptable to a regional bank, but not perhaps to an international bank who is not familiar with Liberia and therefore sees it as also the issue of sort of making it more independent of the American and European banks, also being done in dollars, whereas if it's more recently integrated and we can trade these we can cross-trade our own currencies more easily, then that reduces dependence on dollar and therefore on the external banking, the global banking system. So I'm very conscious that we are running over time. It's received a couple of very sort of what I would describe as technical questions about the survey, like how was the gap calculated and all that. The survey itself is available online, both at the AfDB website and on our website, and I would assume that this is explained in great detail. So what we will do is we will include a link to the survey when we send out the recording and a slide deck. We did promise, I promised you that we would run more than 15 minutes over time, and we are running very close to that limit. So that's promise number one that I need to keep. Promise number two is I promised our speakers that I would give them a couple of minutes each to do some closing remarks. Looking forward, thinking of policy recommendations, what can we do to increase trade finance? Before we do that, there are a couple of comments that have come in that I ask our speakers to react to. The first one is from Andreas Cuba. Sorry, I'm sure I haven't pronounced that right. And it says, isn't the view of confirming banks somehow skewed? $1 billion fines were because they themselves willingly engaged in shady transactions rather than not doing enough KYC on developing market deals. So I guess the spirit of the comment is Africa developed world suffering because they do their homework elsewhere and got burnt? Your views on that. And the second comment is from Amidou, who says cities in Africa and specifically West Africa are watered by the risks related to the area and suggestions for the international banks to deal with that issue. So I'm just going to ask Jan first of all to give us some quick thoughts on that, and then I'll come back to Lamine, and then we'll do the policy recommendations and we'll wrap it up. Jan, if you can get to those thoughts, please.
Yes, thank you very much, David. Actually, the point made on Africa suffering for international banks not doing their homework, it's an opinion. It's the participant's opinion, and it's actually would be partially right because indeed we have not seen many fines among those important fines that were imposed on the international banks that were actually coming from working with an African financial institution that's not compliant. But what we have to understand is that the pressure is so high at their level, and the perception of the risk that they have on Africa is so high, and sometimes rightly, because some of our countries definitely need policy and infrastructure enhancement at country level, at institutional levels. Pressure is so high from the regulators that if we have not had many instances of fines because of African banks, it's probably also because they are so prudent on working with African financial institutions that it actually reduces the chances of those fines related to African financial institutions occurring effectively. But you're right in your comment that sometimes the perception is making African banks suffer from those fines that they have for all reasons at the international levels. A second comment from Mr. What was the comment again? Sorry.
The comment from Amidou was the opportunities in Africa, and specifically West Africa, are thwarted by the risks related to the area. And questions for the international banks to deal with that issue. So I guess from an international banking perspective, how do you address, the risks related to West Africa? And it's not quite clear.
Okay. Okay, David.
Political
actually,
or what?
Oh, sorry. Okay, David, can I go ahead?
Yes.
Hello?
Go ahead.
Okay. Actually, I know that the international banks have any incentive to deal with that issue of the perceived risks in especially West Africa. I would put it the other way around and say, what would African financial institutions, especially in West Africa, do to revert that perception towards international banks? Because actually we have more at this stage. We are the ones demanding those international lines. So we are the ones who should actually take some actions. And one of those actions, as I mentioned in my discussion, are the policy and infrastructure enhancement. And we could actually beef up the policies the Central Bank of West African States has started to do. And what is remaining is the infrastructure enhancement, so that those policies that have been drafted are actually effectively applied in the countries. I think this is what the international finance community would like to see in order for them to affect their opinion. And also what we need to understand is that there is a compliance cost for those international banks to maintain a relationship with any financial institution, especially when the risk is perceived as high, like Africa. So if African banks come together, work together to halfway in the compliance work of the international banks, it will reduce their compliance costs, and I think that they will be then more willing to discuss with our local banks and start to think about reversing trend in the perception of our risk.
Thank you.
Thank you.
Yeah, now, I think let me add a few comments to that.
No, thank you very much, David. West Africa is being singled out in any way. I mean, vis-a-vis their relations with international banks at all. But there are facts we need to acknowledge. One of the small economies in Africa are West Africa. And by you have a lot of small banks in West Africa with small balance deposits. That doesn't really help quite a lot, because that it sort of accentuates the risk of dealing with those small banks. But as simple as this is, I think, what some of the international banks have done, especially in our travels, in our discussions with those banks. The risk managers in these international banks are very bullish about us as a continent. They know the clients, they interact with them quite a lot. Now, usually the credit risk officers and the compliance officers who do not generally have so much experience on the continent. And what some of these relationship managers do is find a way of bringing these credit officers and compliance officers onshore. They travel to these countries to visit these banks and so on. And sometimes they are able to convince them to change their mind about these banks in these countries. So that's one quick way of looking at it. Increasing the engagement between not only the relationship managers in these international banks who look after the local banks in Africa, but bringing onshore once in a while the credit officers and compliance officers to come and visit. And I think, as Jan was explaining, that perception than reality, and basically narrow that gap. Sometimes require greater interaction and communication coming onshore. Many places or in many institutions abroad, risk officers have really never been to Africa or to some of the countries that they're really assessing or on working on. So all we're relying on what other support. I think really the more they come onshore, interact with the regulators, interact with their local bank clients, the better perception becomes, and hence the risk assessment.
Thank you, Lamin. So my question to both our panelists, I guess there are two parts to this question. First of all, is what kind of concrete actions can be undertaken? I think this first one is more than for you, Lamin, because it's looking at the compliance perspective. But of course, feel free to add anything that you would like to add. Kind of concrete actions can governmental regulators take to enhance compliance policy and infrastructure? Because I think one of the things that is coming through in this discussion is obviously a need to strengthen that across the continent. Second point is, what do you think will be the leading issues in trade finance in Africa for the next year? So in a 5-year horizon, so 5 years time, we'll still be talking about the 100 billion trading, $100 billion funding gap. Will we be, still talking about the same de-risking issues? I think I'm going to let Jan take that first, and then I'll come to you. Jan, please go ahead.
David. Okay. To respond to the question of actions that can be done this issue, especially around the AMLKYC and the de-risking, I would personally suggest that countries start first with their national risk assessment exercise, as recommended by the FATF. FATF is the international body promulgating or promoting anti-laundering and terrorist financing compliance standards nationally. In Foundation 1, all countries and institutions subject to money laundering and terrorist financing have to undergo a assessment exercise. So my suggestion concretely at country level should be national risk assessment should be conducted. The bank has a methodology and some technical assistance available on the ability basis, like whenever it's possible for them, because they cannot answer the demand for all countries, but they do assist some of the countries in this exercise with a strict methodology developed for that. So I would suggest that the countries here with the World Bank to bring the methodology to conduct the national compliance AML risk assessment at country level. Based on the results of this risk assessment, they can then develop appropriate policies that tackle the actual risks that country face related to KYC, anti-money laundering. And to ensure policy implementation, they can go up to infrastructure, such as facilities, to reduce the cost. Number of banks in the country can together and, set a center of excellence or a hub to have the compliance matters, so that the country or the group of financial institutions coming together can make sure that policy is consistently applied, effectively applied. Then I would recommend, after all that is done, to feed all that into an institutional risk assessment of the individual banks. And I think that with the results of all that, discussion will be from a total different angle when we go speak with international correspondent banks, with that has been done and put in place at country level and also at local, individual, institutional level for the banking sector. So that would be my suggestion on that. Thank you, David.
Thank you. And so, let me, in the interest of time, I'm going to focus on the second question, so looking ahead. And also, an important question which I don't think we've touched fully in this discussion is, what do you see as the role for DFIs in filling the trade finance gap? And, if you could also do a bit of an auto-critique. What do you think DFI could and should be doing more of in this area?
Thank you much, David. I think I'll start with the first part, really, in the DFIs, where basically say, what can we do? How do we really work to close this gap? I think doing quite a bit, really. Enough. Quite a number involved in this. The MDBs, you have the ERD, European Bank for Reconstruction and Development. They do quite a bit in North Africa. The IFC, who do a lot across the country. The ITFC of the Islamic Development Bank. You have ourselves, PACO, FMO. They're all there. CDC. They're all doing a lot. But we need to be cognizant of the gap is just too huge right now. And ideally, we shouldn't be in this space at all. MDBs don't offer these facilities in North America or in Western Europe, because the file system is able to cater for the needs of the local corporates or multinationals involved in trade. That's different. Now, different more doing this, providing some level of liquidity, but more importantly is providing risk mitigation support. Guarantee, that's quite important, because often it's not about the availability of liquidity, but it's just managing the risk behind the transactions, and that's what we do. These webinars are important in this. The dialogue that we have with regulators, with using the WO to engage the G20, are important. The studies that we are doing is to raise greater awareness, and complementing this with capacity building initiatives, especially for the local banks, so that the more and more get integrated into the international landscape. The bonding between them and the international banks get enhanced, and ultimately that we can really step out of it. So we have to do more, but ultimately our goal and objective is really to become redundant ourselves, really, so that we are not in this space. The commercial play can really fill the gap, but we're a long way from there. If we are, this is going to pan out in the next few years, a crystal ball, but I will see more on the emergence of trade funds. We already have quite a bit on the continent, and funds that are dedicated to providing trade finance support, which banks. That is, I think is going to develop an area of, receivables, including factoring. Africa is really absent in that market. If you take Africa and perhaps a bit in Morocco and North Africa, factoring and civil finance in general is almost absent in the continent. So these are ways where SMEs can be accorded the sort of financing that they want. And fintechs and blockchain, we're going to leapfrog a lot of stages as these things evolve and become bigger and better. And I think they have a big role to really play. But in a few years' time, we can see them really be more active on the continent. Would this king stop? Perhaps. That is not really clear. It all depends on, as Yao says, how we can really improve the risk perception, how we do more on AMLKYC. I think one of the major banks some 2 weeks ago mentioned that it costs about $70,000 to do a proper KYC AML risk assessment on a bank. Now, that's quite a large cost for them, and means in any business relation they'll have to recover that cost and much more for them to really find that to be beneficial working with a small local bank in Africa. It's happening. The SWIFT has developed a KYC register, which really is designed to help banks, provide as much information as they can through that channel. The Afri-Exim Bank also is developing a KYC database for African institutions. Just really help ourselves. Sometimes what you will think is as simple as having your accounts really updated on your website. If an international bank finds it difficult to access basic information on the bank, first, the bank is not good. Two, it costs them a lot more to conduct that assessment on you. Banks themselves need to do quite a lot more in making sure that websites are native, that their annual reports and so on are in a timely manner uploaded and so on, so that basic information on these banks can be obtained quite quickly. Really.
So I think the key takeaways are that it is an issue in Africa. There's a wide gap of 100 billion. I don't know if this is a logical conclusion, but one of the things hearing is that the issues around compliance, AMLKYC, there is a risk of that gap getting bigger. That gap getting bigger is bad because trade drives development and development drives trade. In terms of solutions, yes, the DFIs have a role, but the African banks themselves also have a role in terms of reducing the perception, the risk perception, if I may, but also that the international banks have a role to play, but they are compromised because of the costs, and so it's a question of everyone meeting everyone halfway. So, on that note, I think I've felt dismally on keeping this to an hour 15 minutes, but I believe that the quality of the discussion has been such that I'll be pardoned. So, on that note, let me first of all thank our two really excellent speakers, Lamine Dramé, Chief Trade Finance Officer at the African Development Bank, and Marianne de Claire of Cornerstone Advisory. Thank you also to all of you who have joined us. I think we had over 50 participants from various places. Apologies if we did not answer your question. As I say, I think the vast majority of the questions will be answered in the trade finance survey, which we will include in the email that you will get with the recording and slide deck within 48 hours. So by close of business on Friday, you will get that email. Just quick reminders before we go. First one is that when you exit the webinar and when you close the window on your screen, you will get a pop-up survey. Please do fill in the survey. I know it's annoying. It happens to me when you click on a website and it's a survey, but it is important for us, mainly because we are donor funded. That is what allows us to do our work, and it is only by getting feedback on events like this that we can justify to our donors that we are doing useful and interesting work. The point is that we are really, as I said at the beginning, this webinar is meant to launch our Trade Finance Initiative, which is a new work stream for us. We're really open to collaborate with all parties on that. So if you would like to hear more about that work or have ideas, suggestions about future webinar topics, future research topics, any questions for I will say that because his inbox will be overflowing, but any questions for AfDB, please feel free to shoot us an email through Making Finance, through the Making Finance Work for Africa website or the Secretariat email. The contacts are there, and as I say, we are really looking to expand our partnership, particularly around this trade finance initiative. So please feel free to reach out to us if you would be interested in contributing anyway to that. With that said, I would like to thank you all very much for joining us. Thanks then to all our speakers, and we look forward to seeing you on our next webinar. Thank you. Have an afternoon.